Hi, today I'd like to talk about CQG Algos. We will examine current functionality as well as look at what's coming soon. First, let's talk about TWAP. TWAP is an algo that lets you trade over time. It stands for time-weighted average price. There are several standard parameters for TWAP, an important one of which is max duration, or you can set a start and end time. Users can also specify wake intervals and override child order sizes. Here we'll send a vanilla 50-lot 1-minute TWAP for E-mini S&P futures. For more advanced functionality, it's worth noting that all CQG algos are trees. That means that child orders of algos can also be algos. So each child of TWAP here is another algo called pay up. By default, TWAP children pay up immediately and cross the bid offer spread. But advanced users may want to try to work bids or offers if it's probable they'll get a passive fill. For this, we use pay up models. We have several pay up models. Immediate is the default, as I mentioned. Simple allows the user to set an opposite inside market size or size ratio under which the slice will pay up. THEO-Q models the order book as a Markovian queuing system, using bid and offer size and order ingress and egress rates to compute the probability that the market will move our way before it moves against us. So here I can launch the same TWAP with pay up logic to avoid crossing the bid offer spread when the math tells us we should. Now let's talk about the VWAP algo. VWAP is an algo that lets you trade over a predicted volume distribution. It stands for volume weighted average price. We use historical data to compute a predicted volume distribution and use this curve to size child orders over the horizon of the algo. Here again, we have duration parameters. However, again, we offer more advanced functionality. I would price. This is the price at which the algo will indiscriminately take liquidity up to size at this level or better. This allows the user to express a desire to deviate from the VWAP schedule for a really good price. Here we'll do a 50-lot VWAP with an I would price. Now let's talk about arrival price. Arrival price uses realized volatility and the cost of liquidity to estimate market diffusion and execute your order over an optimal time horizon. The math behind arrival price is the subject of a white paper we published in 2021. Remember, algos are trees. The arrival price also has pay up children. We use the same probabilistic computation to decide whether each slice should aggress or remain passive. Arrival price can also split slices into aggressive and passive portions. We also allow advanced parameters here. Cost models. Cost models allow the user to change speed based on market level. Optimistic will accelerate if the market is moving our way, but will stay optimal if the market moves against us. Aggressive will accelerate if the market moves with us or against us. Let's send in a 50-lot arrival price order with the limit a few ticks through the market. Algo orders can have market or limit semantics, and if we set a limit price, the algo will do no worse than that price, although this could result in an incomplete fill. Arrival price is benchmarked to mid-market and sweep to fill. This slippage number is a measure of performance against the mid-market price at the beginning of the execution, and the slippage sweep number is a measure of performance against what we'd have paid if we used a market order instead of an algo. Negative slippage here is good. It means we saved money. Here, using our Algo Analytics widget, in this example, we beat mid-market by 12.5 cents and beat sweep to fill by a quarter. In E-mini terms, that's $12.50 per lot. So for a 50 lot, that's $625 of real money we didn't have to pay a market maker. Additionally, we have several other algos in the suite. POV is an algo that lets you trade over time as it evolves. This is different than a VWAP as there is no predicted curve. Snipe. Snipe will lie in wait for advertised liquidity at a target price and send aggressive orders if this price becomes marketable. SL Snipe. SL algos have stop limit semantics, so I can place a snipe buy above the market and a snipe child order will activate if the market trades at our price. Now let's talk about what's coming soon. Machine learning algos at CQG. Our new machine learning algos are currently being deployed in a limited production beta. We built our custom ML models and training infrastructure from the ground up in an efficient and mathematically satisfying way, warehousing many terabytes of historical market by order data in the Apache Parquet format. In version 1, there are two main classification targets: next best bid, either up, down, or unchanged; next best ask, either up, down, or unchanged. Models are trained continuously and shipped to the algo engine as the system detects the need for a new model. We then featureize live market data on the fly inside the low latency algo engine to estimate a probability of the next bid or ask being up, down, or unchanged from the current value. In live data simulations, we see high 70% to low 80% accuracy of the signal consistently through normal trading hours. This signal gives rise to a new class of algos. The first of which is PayUp AI. PayUp uses these probabilities to detect whether to aggress or remain passive. The user can enter an optional probability filter in the form of a sensitivity so that the model will pay up only if it's that percentage sure the market will move against us. Similarly, we have Arrival AI. Version 1 of Arrival AI uses PayUp AI children with our standard arrival price models. The next phase will use PayUp AI children and additional machine learning derived short-term price signals to execute optimally. Thanks for listening. CQG Algos are available in our GUIs, our Fix and Web APIs, and through popular OMS systems. If you're going to trade, trade optimally.